Hi everybody. Thanks for having us in today. We're a company called 3AI. We officially formed in December last year, although it's really the combination of about 12 years of work and former startups that have been gobbled up into this. And we want to talk today about machine learning breakthroughs in finance, which I think is probably relevant for lots of you here. Just a quick show of hands, is who here is interested in kind of data science, machine learning? And everyone but one. The one. And who here does other stuff like cyber or has other kind of, what areas you're specialising in? Anything?
Most of them will be interested in finance.
Okay,
trading things.
cool. Right, okay, so let's crack on. So the first thing I want to look at is classes of outcome for AI tests. So there's a lot of hype at the moment and excitement as well about AI. High human, we kind of think of us as like an expert, and then superhuman is what we're going to really talk about today, stuff that we believe is outperforming human capability. Optimal kind of doesn't exist unless the problem's simple. Optimal basically means completely solved. So if we look at evolution of superhuman AI in games, we'll all be familiar with IBM, Deep Blue 986, former UCL people who've created DeepMind, did Go in 2016. 2017, a team in America from university solved No Limit Hold'em Poker. That was called Librados. And more recently, we're starting to see superhuman AI in another non-perfect information game, StarCraft. So if you look at that flow there, we can see that perfect information games where you've got everything available to you were kind of easier to solve, and games of non-perfect information where you've got injections of randomness, a little harder. Key ingredients there is really that these things are kind of clearly definable into logic, aka can be coded, and in the case particularly of non-random, that there's some kind of like statistical or mathematical element. And finance, and I don't think the world has kind of really caught on to this yet, but finance really is mankind's biggest game of math and logic, or certainly mankind's biggest commercial game of math and logic, and it's completely amenable to AI. And these are kind of 4 problems here that we've solved, either, or should we say mapped machine learning to effectively. And we do believe that every expert task within finance is machine learningable to a standard that will surpass human capability. The first one we're going to look at is ALM. Is anyone familiar with asset liability management? Just a few. So, okay, ALM is done by all the world's biggest financial services companies. If we think of it as a game, it's basically an insurer, case in point, an insurer will have a long-term flow of liabilities. They've got all the world's bonds and typically fixed interest instruments that they can look at to match them up. They get rewards from the regulator by having the future cash flows of all these bonds matching to the liabilities. The better they match, the better the kind of like credit adjustments, etc., etc. It's a very complicated game because when you get into dealing with a real insurance company or a bank, you've got tons of third-party contracts, internal risk limits, limits to issuer, and in the case of even looking at like just a UK insurer that only operates in the UK, maybe 700 different bonds to select from. So the complexity of the game is rather large, and it's typically handled at the moment by ALM actuaries who are not particularly versed in financial computing like you guys. They're using things like Excel and VBA. Some of the complexities that you'd be dealing with. This one is with reference to examples that we've done for insurance companies, talking about IFRS profit, again, capital. If you don't hold enough capital, like you buy too many risky bonds, then the regulator comes in and kind of will take you out of business. You can't really do that, and then that therefore hits your profit. So there's all these intricate push and pull relationships. And it's kind of like Tetris on steroids. Because if you think about what a bond is, it's this shape, a load of coupons and a big redemption at the end, and we have this liability flow. And the objective of ALM is to optimally put these things into that. You want this to look as much like that shape at the end by combining them all together, but you've also got all the intricate cross effects and impacts of the credit capital charges. Where do you use up your capital, like going into higher risk, higher yielding bonds at the long term, the short term, all the different available assets to you. And the other thing that's interesting about this game is that whilst all insurers or banks are accessing the same asset pool, they're all actually playing a different board game because they agree different calculations, etc., with the regulator. And it's a bit like the travelling salesman problem, which if you've studied evolutionary computing, in particular, you'd be familiar with. So this was like a problem set up in, I don't know, like the 50s or 60s in America, how to come up with the best route to get between 50 different cities to help a company with their logistics of optimizing delivery. The amount of the spaces within this is like 3e to the 64. Again, it's pretty ginormous, so you can't brute force the solution. Evolutionary computing is finding the best answers for this. This is us tackling an insurance company's balance sheet using evolutionary computing. This is just to give you an insight into how the system evolves better solutions. The colours here actually represent the quality of the solution, but in our own objective space, which is looking at capital, profit, liquidity, amount of cash released. So creating our own bespoke objective function, we're seeing that we saw that the self-learning mechanisms essentially solve the problem. Spinning that using, say, principal components analysis into, say, 3 dimensions down from about 700, you can actually see here as the colours change, you're actually seeing different solutions to the problem. So every single one of those dots is like a complete mapping of the entire balance sheet of an insurance company. So this is looks like, but isn't exactly real data from an insurer that we did this on. And what we saw here, quite logically actually, is that there's a trade-off between profit and capital. This is the insurance company as it currently stands, so no change. Here's a boost in profit. This is finding a boost in capital. Anything essentially here is a completely dominating solution because you're getting more profit and more capital, and you're getting cash release because you're holding bonds with more yield that are able to therefore free up capital going to the surplus assets, which for an insurance company is, if you look at like Warren Buffett, that's where really he's making his juice in the surplus side because you're more free and you can invest those assets. So it also discovers a kind of efficient frontier space. Obviously, that solution dominates that one, for example. The solutions that come out are quite different each time. But then we created lots of algorithms in series using different methods, and they get better and better. So that was done in 2015. I think that was the year before AlphaGo. We picked up an award in 2017 for that one. The chief actuary valued the AI at about 50 million to that company, and they adopted lots of principles in their investment strategy. So they kind of learned from the AI, and it created this symbiotic process where the insights revealed from the machine learning would enable better questions to be asked, which would enable better questions to be asked of the AI, which would enable better answers at each iteration. So it creates this kind of human machine learning symbiosis. And over 2 billion bonds were traded by the insurer out the back of that. We believe it to be probably the world's most advanced system for asset liability management. And asset liability management is a huge opportunity that no one's really talking about, because if you I think something like the 8 largest financial services companies, the assets that they hold is larger than US GDP. If you look at like the top couple of hundred financial services companies, get the data out of Reuters, you'll see that their assets are larger than world GDP by about 20%. So by extrapolation, applying this to the world's financial services companies, we can see the ability to release about 2.5 trillion in capital, and likewise with profit, close to a trillion in profit potential. However, the first companies to use this would reap the best results because their activity will move the prices of things. So comparing this to AlphaGo, and they happened around the same time, I kind of saw a lot of similarities. In both cases, we were trying to outperform an expert. In AlphaGo, it's a Go player like Lee Sedol. In the with this, you're trying to outperform actuaries essentially, or trying to help them to get a better insight. Complexity, again, more than atoms in the known universe in both cases. Likewise, expert view in both cases. If you think about Go, it won't happen for another 10 years. With the ALM, we weren't sure if it would actually work and solve the problem because it just seemed too complex. The outcome is that essentially it went on to beat the professionals and in time to teach them. The big difference is that one's a board game and one is well, we think the release opportunity is over $1 trillion. The next is stock picking.
Can I ask you?
Yeah.
You haven't told us what models you're using.
So in the first one, we spin the bonds into, we make all of the bonds a DNA sequence. So we're using genetic algorithms and we do crossover. This is what this is. That, you see.
So you're using GAs?
We're using genetic algorithms, yeah. And the bit to solve was how to map the objective function to solve it all, and coming up with new ways to modify genetic algorithms to solve this specific problem. But our conclusion actually on genetic algorithms and evolutionary computing in general is that they can handle infinite complexity problems, because this was basically what we would say is a near infinite complexity problem, in the same way that we see that in other areas of machine learning.
Did you look at other evolutionary algorithms to see if they were better than GAs?
We used other algorithms that weren't in evolutionary computing as well at the end to prune. So we use evolutionary computing to solve 98, 97, 99% of the problem, but with like a GA, you're trying to find the kind of global optimal, but you don't necessarily prune in. So if you think of like Edward Scissorhands pruning the bush, we then created or used other algorithms, either bespoke or off the shelf, to then zoom in locally to just push little bits of.
Like principal components analysis, something like that too?
No, because PCAs, that's to spin things, to reduce the things into linear, like orthogonal space. It's not really search. Yeah. But I can say right now, and we specifically don't talk in detail about the machine learning that we're doing here. We're talking more around like the results and the opportunity that lies in finance for the applications of machine learning. And that we strongly believe every single problem that experts tackle in finance could and will be converted into software and gamified, and effectively then have machine learning methods applied to it. Every single problem that I've looked at in actuarial trading, and our team into asset management and the like, all of it is highly amenable. And actually the stuff that we're getting there now using machine learning is way more advanced in terms of results, its ability to dig through information and solve complexity and learn from data than what is possible for a human. So if you think about stock picking and investing, it's actually impossible for a human to be an empirical expert in equities. We've got a database of over 1.2 million years now of stocks. If you put them all in sequence, it's 1.2 million years, which is a longer sequence than the existence of our species. So forecasting equities, again, I won't explain too much. I won't bother going through this, because I think everyone knows what we're talking about here. If everyone know what an equity is? Okay, good. So the question is, can machine learning and data replicate the kind of learning or the thinking of someone like Warren Buffett? And this one's actually from 2003 in his afternoon session of the annual Berkshire meeting. So has anyone watched Berkshire AGMs? We've got one. Okay, two. I think if you want to understand about stock picking, there's no one better to learn from than Warren Buffett and Charlie Munger, and in the UK, Terry Smith, that deeply understand that what a company is really about is how they treat shareholder capital and what they'll do with that. But it's quite interesting here that he said in 2003, what you need to do is form a database in your mind and use it to reference back. And specifically says things like, we don't talk to management, we didn't visit Clayton Homes when we bought them. We use the record, i.e. the financials, to make our decisions and to evaluate everything about a company. And it completely makes sense, because in reality, everything about a company is just numbers. It's just the finances of a business. Like we think about a business as colourless, cashless, odorless, colourless cash printing machines. And what we really care about is that they're printing cash quickly, the speed at which they print cash is speeding up, and that they've got no kind of electricity or sparks coming out of them, i.e. they're not going to blow up, aka default. Interestingly, default models are not usually considered by equity investors, but a stock defaulting has 100% impact on you. You lose everything. With a bond, you lose like 50%, so it's actually less of a consideration for a bond, but because it's anything that they price on, it's anything that they focus on. Anyway, I diverge. Alba has been built over 12 years. Alba's actually what brought me back to study machine learning here when they've created the first machine learning program, the first CSML Masters, that's the CompStats one, in I think around '08. And there's been about 5 million of R&D into this. And in a company I created before called Alchematics, which was, again, people from the machine learning program working together to kind of solve from first principles, investing in trading, and map it into machine learning. There's about first 5 years, mostly we were discovering things that didn't work, but we had a very tight restriction on the way that things worked. The tight restriction was we weren't having backtesting systems, we weren't trying to make systems that made money, we were trying to solve the problem, i.e. to engineer intelligence that could develop the expertise, that it could be a guide for us in the sense that you could ask it in the same way you could ask Warren Buffett or a Terry Smith, is this a good company to invest in, is this a bad company to invest in? But before we show any results on that, I want to talk about bucket ordering. So to make things visible, because we're forecasting all of the world's stocks, we put everything into like 100 buckets, just top to bottom. Alba is essentially forecasting everything, but by putting them into buckets, you can actually see, otherwise you've just got a plot of like 16,500 stocks moving around, and it's quite hard visually to see. Also, it gives us a nice statistical framework because this is the random distribution of ordering 100 buckets. So if you put all of the world's stocks into 100 buckets from top to bottom, then we already know that from sampling the ordering of 100 things a million times, about 45.33% correlation, I think, in that one, was the highest that we observe in a million trials of doing that. So anything above that is completely like impossible to generate by chance, and around about here is about a 95%. Does everyone follow what we're saying? Yeah?
So how do you do the bucketing? So is it based on your score of how?
Yeah, exactly. Yeah. So although the score is not an integer, we just turn it into 0 to 100. So there's like in the most, when we went live with Alba in May this year, that's like there was 16,000 I think 400 odd stocks or something. So sorry, 16,040. So we had like 160 roughly in each bucket.
What is the score again? Is it the return of the stock?
The score is, the AI is forecasting stocks. The score is essentially just ordering them from top expected performer to lowest and then putting them into 100 buckets.
So it's
Yeah.
return on the stock, right?
Yes. They're ordered by forecast return. So here we look at stock sorting on global liquid stocks, everything over 50 million market cap. I think liquidity, Simon, was it $10 million a month? Something like that, yeah. And we did that on purpose because if you have very illiquid stocks, the prices that get printed can be completely bonkers and they screw everything up. Plus you couldn't really trade them anyway, so you're better off cleaning them out. So over here, this is at the start. What we look at here is a rolling 10-year observation on Alba as Alba learns. And Alba actually starts around 1974. That's when our database goes back to. Now Alba only sees the past of the past, so Alba doesn't even see any features up to a year before the point of doing forecasts, because obviously there's no Y, there's no return to even learn from, if you see what I mean, right? So if we just simulate this through, over here, recall, this is the correlation achieved. Now this one's a rolling 10-year, although it starts at the first observation will be 1. So you see here, you see quite quickly it's surpassed the best in a million. So with certainty, the AI has learnt things. And as we go through time, this gets better and better and better and better. So in 1986, that's 1976 to 1986. So that would be 10 years, there's 12 months, so 120 observations, and then packaging them all together. Here we're talking about alpha, so that's the deviation of those stocks from average return. So and you'll see it move around as well, like the credit crunch, you'll see that have an impact. The dot-com crash has a slight impact, and you see this thing move around. But you can see in 2005 here, that's 1995 to 2005, that's 120 monthly 1-year forecasts, and this is the average of all of the stocks in that bucket over that time. So it's 100. That would be about 100 stocks times 120 in each bucket. So we can see at April. So this is 2009 to 2019. If we put all of those forecasts across all of that time, across all of those stocks, and put them into those buckets, that it's doing ordering stocks in a way that is completely beyond the possibilities of chance or randomness. So it's 100% learning things that are working. And we can see in the bottom buckets, that's the bottom percent of stocks, about minus 32% alpha. So that's deviation from average market return in that year, versus maybe 10, 12 at the top end. Does everyone follow that chart? Yeah?
What data is this taking as an input?
Lots, a hell of a lot. Should we get to that at the end? I mean, I can answer that now if you want. Okay.
Is it fundamental financial data?
Yeah. Yeah.
You're only using fundamental financial data? You're
No.
not using social data, alternative
We
data?
have text information, so it reads things, like it reads stuff to mine, for example, credit risk. Analyst reports are in there, but again, it's all converted back to quantitative. So analyst reports are used to build, at that point in time, the visible analyst reports build the future financials as well. So you've got a future and past financials. There's about 18,000 analysts monitored on a live basis, so, and going back through time.
But it's just financial data, you're not...
No, we took a universal approach. So really driven by Da Vinci's fourth principle for development of human genius, which is in there actually, which is learn to understand that everything is interconnected to everything else in some way or other. It was clear from, I mean, there's about 1,000 papers and a couple of hundred books read before we even got to the machine learning application. And it's pretty clear that, I mean, there's no smoke without fire, right? There's reasons that momentum exists, there's a reason that value investing exists, quality investing. There's a reason that Buffett and Terry Smith would talk about valuation, not value, and that value is basically BS. There's a reason that basically everything from every investment philosophy, that we've got it all in and we haven't really pruned it. We've just got information and put it all in. And then, but I think what's really enabled the machine learning to work is the deep engineering of features that enable it to think like a person thinks about a company.
Can I just ask a clarifying question on the chart before that? So on the alpha thing.
Yeah.
So if you go to the 2010, so the latest one, if you run it, so the best bucket is something like,
this one?
Yeah. So the best bucket is something like a 10% alpha over 10 years?
Yeah, average, yeah. That's yearly.
Yearly, 10% yearly, yeah?
Yeah.
And then the worst bucket is something like minus 40 or minus 30%.
Yeah.
So that means that unleveraged, this strategy is making something like 30 or 40% a year, year in, year out.
Yes, yeah, between the top and bottom percent, yeah.
That's incredible. That's unleveraged.
Yeah,
I don't know any fund that does that. So
the live stuff that we're seeing now, which we'll get to. I'll show you in a minute the live stuff we're getting to now, and we're sharing it with hedge funds and stuff like that. So, but yeah. Yeah, I mean, to be honest, with the work that we've done, the team that has been involved, we don't believe a human can compete with Alba. But right, anyway, so passive investing, 0. Here we look at training days, the amount of compute time that went into Alba. If we divide that time period that we just looked at, which is actually no, this is since inception of the MSCI World Index, I believe. But yeah, we split that time period into two, so 85 to 02. And we see that with a certain amount of compute, the average outperformance beats passive in that time period. Very limited compute, it actually underperforms passive. It's actually learning kind of, what it's learning is, I guess there's elements of noise and overfit more so. But this is very much to do with the way that we've structured the algorithms for learning, specific to the problem. And that's a log chart, so that's a lot, it's 10 times here, and that's 100, 1,000, 10,000 times the amount of compute, right? And it seems to be tailing off. We think we're kind of like sucking out the info from the data. The real key is actually thinking deeply about the algorithm, that the way that it's learning is tending to the truth as the amount of training tends to kind of infinity. So that's Warren Buffett over his career. Recently, over the last 30 years, he's actually about there, but he's had so much capital, it's kind of unfair to put that on him. So we kind of think of that as a superhuman performance. If we look at Alba over the last 17 years, again, it's a walk forward, so it's never able to see anything in the future. All of its learning is by itself. We don't tell it to like companies that make more profit or make less profit, or to like companies with good momentum or short-term spikes, nothing like that. Let it learn everything. we see that over about this amount of compute, it's just about surpassing his career performance. But there's a free lunch from machine intelligence. So this is, when we think of like stock picking, if you really think about it as a stock sorting machine, like if you think of an investor as a stock sorting machine, right? A bit like Simon Cowell and X Factor, like sorting through the different people and putting the best 5 through. And in investing, you've got the same problem. You've got a load of things, you're going to sort them, you're going to put the best ones through. If we sample here, like I think it's like our database of like 1.2 million years of data, but we turn every stock into a time-specific alpha and then produce in each dot like 10,000 randomly generated portfolios by a stock picker with a preset correlation. And this is single stock correlation level. So 25 at single stock is way higher than like what we saw before was in percentile space. And percentiles, a lower level of correlation at a single stock level is going to get you much higher in percentiles, right? Because it all groups and it washes out noise. So the what you'll see, this is just basically getting to the truth using stochastics of the mathematics of stock picking. That if you increase for the same skill level the number of stocks, and it's kind of common sense, people who I speak to who don't know anything about investing or stats get this off the cuff, that you magnify your skill by looking at more stocks. But a human investor can't really look at maybe more than 200 stocks. Even like Terry Smith, his investable universe is about 80 or 90 and they limit it down so they can deeply analyse the companies. Whereas a machine can basically look at everything. So for the same, we need a lower skill level at stock picking to get a much higher return using something that looks at all the world stocks. Again, this is a walk forward. So this is since inception of the MSCWI index. That's the world index. And there's Berkshire. And we'll let this run. And we see here it's matching passive. It gets better and better through time. It's beating passive. Underperforms here during the dot-com boom when stupid stuff went up. And from about here, it's closing the gap on Berkshire. Mind you, Berkshire, you will notice, is slowing as well. So it looks more like slightly better than Warren looked in the very early years of Berkshire. But then in those years, things were very easy. You used to look at an almanac and you could just find companies that had like 100% or 50% yield. And just by looking at all the data, buy those, and it was quite easy. You don't really get that opportunity anymore. So I think that the modern day version of where Warren started is to do this, which is to deep dive into all the world's companies and do it this way. So, but if you look at the last 20 years, starting with the same capital base, and again, it's an unfair experiment because they've got so much capital in Berkshire, but starting with the same capital, Alba had 14 times as much capital 20 years later. But that's partly the power of compounding, as Einstein said. I think it was like the eighth wonder of the world or the universe or something. So we also applied to like long short trading. All these are using real trading costs, real slippage models, real liquidity limits, real market cap filters and everything. We realized, like, hold on a minute, if we built this originally in a sense for ourselves as well to do investing, but that if it's really accurate at the top side, and exactly to your point about seeing more alpha on the short side, why not do long short? So this is now, we're now trialing this. We're starting in Jan actually with a hedge fund, doing long short trading. And again, we can see the performance is pretty consistent. Now, the thing that's quite unusual is that we're using 1 year forecasts. The average holding period, just like in the system above, the average holding period is about 4 months. That's what Alba's finding optimal. Alba looks a bit like a sun seeker because she's figuring out her own filters on trading costs, figuring out her own like exit levels. So the exit's really simple. It's a solved Markovian process, right? You know, Markov processes, the future is conditionally independent of the past given the present. Well, all the information that you have available to stock is in the present. So if you're not human and you don't lose your mind when the P&L goes against you and all the other things that humans do, but just purely think about based on all the information available to me now, like an effective poker player, I'll play statistically the optimal hand at each time, then you get expectation maximization in investing. If you've got a system or a human and you can model their expertise via the strength of their forecast, or in Albert, it's very simple because it's a number, then it's very easy to just have like exit levels as the system learns itself as that the kind of like Alba score drops, it will just get rid of stocks and stuff. So it's all, everything's self-tuned. So live since May 20th, so we were actually, Alba in its current form was completed, and this was the first batch of forecasts that we did. So forecast of all the world's stocks, May 20th. So that's running it. You see it on a daily now. Here you'll see we've reduced these numbers because actually this is only now looking at 6 months up till the 20th of this month. So the best in a million and the P99.5 have dropped a bit. Sorry, no, they haven't dropped at all. What am I saying? The historic average has dropped because over 6 months, the achieved correlation falls relative to what you'd expect over, or what you see over a year. And again, we're seeing over a 6-month period, further to your point, about 22 on the short side and only about 5 or 6 on the long side. We consistently see this kind of log shape, that there's more, it's finding more alpha on the extreme short stocks. But we also find that in the large cap space, or even like over say 10 billion, virtually no stocks below 20. So a lot of these stocks here are very iffy companies, but they wouldn't be necessarily hugely investable for funds with large amounts of capital. They'd be tradable by everyone in this room probably, or certainly on a personal basis up to like 20, 30, 40, 50 million. And again, here we have, we then looked at this and we were kind of blown away actually by the results. When we compared it back to randomness, we were like, and again, in terms of the return, it's kind of quite mind-boggling that you see something like 30% shift in the price of one thing to another. And given that those buckets have like 160 stocks in each, you know, it's almost like a whole index that's just crashing to the floor at a rapid pace. We think that the reason that that's being found is because what's happened with the machine learning and the way that we've engineered features is we've managed to enable the learning process to learn and do the kind of deep capital analysis and financial analysis that you don't even pick it up in the media. They don't even talk about the kind of things that are really relevant to making money and investing. So here we have a live performance, so we go top percent, bottom 1%. So it's just one less the other. No adjustments made again. This is the distribution of that, so you can see it's actually quite tight, right? So you could buy 160 stocks in a long portfolio and short 160, and you probably, by randomness, not going to do much more than 5 plus or minus 5%. It's quite hard to deviate. And the best in a million is the best in the million of the randomly created portfolios at that point in time. So it's not actually one portfolio. There'll be ones that shoot up because of some crazy stocks crashing or going up, and so it'll be multiple portfolios achieving that. And then this is the top 160, bottom 160. Pretty much went over the best in a million by randomness. So and kind of stayed there. Seems to be roughly keeping pace with it, but maybe a bit more consistent. But that's not really one portfolio, bearing in mind that's the best at that point in time of the million. So if we'd had a time machine and that original list of a million different 160 versus 160 portfolios and Alba, we would have done better with Alba than with the time machine and the million by a million portfolios. Mind you, I think you probably would too with Warren Buffett if you look at long-term investing, or with people that seriously outperform. Like I think any top hedge funds will be outperforming the capabilities of randomness. Yeah?
Sorry, I can't stop myself. I'm sitting here and really trying to understand. I mean, I understand you can't talk about the specific, and I respect that very much. But you see, I used to be a portfolio manager in a hedge fund. This used to be my bread and butter. I know people who work in the Renaissance Capital DE show who have a lot more budget for R&D, a lot more years of experience. Yeah. And the best they can do is about 10-15% alpha a year. And we're talking about 1 in a million fund. Yeah. So clearly you've identified something here that these people haven't seen. And I understand you can't talk about it specifically, but just conceptually, if you could tell us a little bit, what is it? Because clearly it's not machine learning, it's not computation, it's not data. It must be something else.
Honestly, it's this. So this is the training time, but that's the training time for the machine learning. We also have about 2 days of compute time for feature engineering. So it takes, before things are run, looking back at the historic data as it goes through, we've engineered over 300 deep intuitive features that, and we tried to mathematically engineer them to replicate somewhat feeling that we would get looking at data and also the way that we would analyze into a company and the kind of questions that we would ask, enabling that it can see that. The fun that you see, people talk about building AGI, but the secret, the reality to building AGI is it's never going to happen at the moment because I've just had a daughter, she's 3, and for the first 2 years of her life she could barely talk. She's coming on a little bit now and Like, you know, about 2 years to learn to walk. If that was an artificial intelligence experiment, that experiment would have been binned, and yet that's a human and going to build incredible intelligence. The key to machine learning is giving it the senses to see.
Right,
So
what you're telling me there, if I understand you correctly, is the secret is power and computing and amount of computing power you get.
Well, that's improving it too, because more compute time, the training is becoming more robust. It's getting out more of the generalized learning and reducing the random patterns that are being found. But the real key really is I think feature engineering. So which fundamentally comes from understanding the problem.
I just want to this point. Like feature engineering, you guys doing, is it manual? It's like pen pad?
No, we couldn't manually do it. I mean, manual in what sense?
Well, you guys are deciding what kind of features are. So like, what's the definition of quality? What's the definition of value? Or you're just doing it back propagation? So what do you guys?
Yeah. So all of the features are just measurement. They're not. They don't have any view in them. They're just measurement. But it's enhancing its ability to see things, basically.
It's selecting those features based on a deep understanding of equities and the equity market. That's the thing.
Yeah.
That's when you say you're giving it senses, you're giving it a huge number of really important features that are engineered absolutely.
I don't want to go quick inside because you guys don't want to disclose what you guys are doing.
Yeah.
But like for instance, you have a text, you do a word to back, so it transforms this text into numbers, and then you fit this into whatever you're testing. Is that the kind of feature engineering you guys doing, or is it something different?
That's not really. I mean, that's a part of like NLP process and stuff, but which is in here too. But there's a number of things. I mean, for example, there's transformation of data, which has given 150% boost to learning. It's reframing the problem. I mean, we spent 5 years rethinking the problem from first principles and figuring out all the ways that machine learning didn't work in solving this problem. I think to Simon's point, the key is that you're not going to solve investing just getting financial data and bunging it into an algorithm. It's not going to happen. In the same way it went with the ALM. You need to first understand the problem, and I think understanding investing at a deep level takes many, many years of research and reading. In our case, because we're doing the big long-term forecasts, obviously financial information is very important. If we're doing like one-day forecasts, financial information is not important. It's more news, media, or announcements if they come out. So it does change depending on the forecasting period. But because we're in a kind of quasi trading / investing time period with Alba at the moment, but Alba can be put to any time, and then we see an adjustment into the importance of things. But how do you think a human learns in this field? Because it's interesting to me that in investments, people are very dubious that this can be learned. But how does a human learn? Human learns by understanding the problem, and this is a different way of learning, because I think Warren Buffett, in a sense, would have learned, which we could do by sitting and talking about a company and how capital flows in a company and how you get money out, which is basically like profit or free cash flow. Alba's had to learn in a different way, which is how do all these things then relate to return in an FX neutralized total return space. But I think to answer these questions, we could have like a 1 hour session on each question. Let's see if I can remember where we are. Yeah, so with the live, again, we were kind of blown away. We're getting kind of holy moly. Like, if we just bought these stocks and sold these, we're making a very short period of time. Like whatever we saw here, this one's without any costs in. This one's academic in the sense it's purely statistical. It's purely about information. It doesn't have trading costs and stuff in. But even still, very big or significant returns. A lot of those stocks, though, on the short side have very high short rates, so you wouldn't necessarily short them. So case studies, just to get, this might give you something of an insight that we've ripped lots out because we were aware with time. I actually ripped 35 slides out just before we started, which was from this section, looking into like company analysis and talking around companies. That's how you'd start to understand kind of how Alba thinks. But it's really, AI is designed in the image of the thinker to an extent. AI or machine learning is a way to get answers. The key is asking the right questions in the first place. If you're not asking the right questions, you're not going to get the right answers. So Carillion, looking back at Carillion, here we can see, anyone aware of Carillion? They went bust 2 years ago as a construction company. They had a big write-down, 845 million on a load of contracts for construction jobs that never came through, or it was all a bit iffy, as many companies go bust are. But if we think about purely measuring this company in terms of earnings yield, which is how smart beta funds work, which is a lot of the ETFs in the world, you would see that after something like a 40 or 50% price fall, the earnings yield jumps up enormously, because it's really just measuring the price of the company, market capitalization of the company, divided by the profit that the company makes. But the profit the company makes for a factor fund, or even for Alba, is still measured on the same accounts that were written last March, last June, or whenever. So the earnings yield jumps up, which, let's take this forward, which significantly tricks a kind of value factor, right? So the value factor here on like earnings yield is like a 98th percentile stock. Once the price falls, because of the big write-down, it shoots up to 100. In this case, in hindsight, we know this method response was wrong because this company carried on declining and going bust. With Alba, we saw that the response turned out to be in the right direction. She quite liked the stock at the beginning, probably because it did look very cheap. But actually, there's a massive, significant decline. Using algorithms like, for example, Shapley, you'll have seen, there's various algorithms now that enable you to see into machine learning and what it's thinking. We could see that on we've got over 300 models that we look at, but we could see, just drawing the attention to 3 of them, if we looked at the weighting that Alba was putting in her thinking onto valuation and volatility analysis and comparing it before the write-down and after the write-down, we saw there was a massive downshift of 87% in the valuation models. Valuation models are just driven by last year's financials. So it's basically saying that I'm seeing where I've seen companies like this before and the price has dropped by a huge amount in a very short period of time. It's quite obvious that the prior financials are now kind of BS and I shouldn't really pay much attention to them because I can see that with other companies. But with volatility analysis and momentum and technicals, it's kind of shot up. It's becoming something more like we might think a technical play. I don't know if there's stuff in here where we can. So, and if we look at the top and bottom stocks there, actually the top stock I've replaced with the second top stock, Ferrari, because we had other stuff in there talking about the actual stocks and going into detail on them. I thought it might be a bit more interesting, but you wouldn't have probably known the first. The very bottom rated stock at May 20th was a company called Natural Shrimp, and they have a patent for waterborne diseases. Apparently very important in the shrimping industry. I know nothing about the shrimping industry, but I did look at the financials. And I did see that they had no revenue since 2015, that their profits are declining. Obviously, you can't make profit with no revenue. Their free cash flow is declining and increasing in its rate of decline, that they're refinancing their business by raising debt, which doesn't hurt future profits, or in their case, increases future losses. But they're also issuing more equity to keep themselves afloat. They're financing themselves just by issuing. Now, if you're issuing equity and you're a shareholder, it's like the profit or free cash flow of a company is like the toppings of the pizza, and issuing equity is giving out more slices and having to share those toppings among more people. It's a very negative impact because you're essentially owning less, and in this case, less of a loss-making business that, to my mind, doesn't even have a kind of business, right, as a listed company with no revenue. So in a way, it's got no proven market at all. It's very much a speculative. It's like a startup that's listed. But, you know, that patent could turn around and it could be worth 50, well, they're priced at 53 million already at May 20th. So, yeah, maybe the patent turns around, they're worth 50 million or worth a couple of 100 million. But it certainly doesn't seem upside as an outside bet that warrants a 53 million price. By the way, none of this is a recommendation to buy or sell stocks, and we're not here to do that. We're just doing pure data analysis. And Ferrari, which is a very highly rated stock, very clear business model. In luxury goods market, actually that's growing more than the auto market, luxury market, with basically the rise of brick nation millionaires. And their profits and free cash flow are growing pretty aggressively at the time of May 20th. But also they're treating investors nicely. They're doing buybacks, essentially reducing the amount of slices, so you're getting to own more of a company, and that company is getting better over time, which compounds the effect on the investor. Return on equity, again, they're able to use the capital they've got very efficiently. So return on equity is like the yield of a company. If you neglect the price outside, it's considered the most important metric, or return on invested capital by Terry Smith, the UK's top investor. Margins growing, zero bankruptcy risk. Their free cash flow in a year could write out all their current liabilities. And their current assets are about 4 times current liabilities. It's only current liabilities, current assets where you're going to think about risk, right? That's where liquidity is what kills businesses. It's not lack of profit or balance sheet. You can have massive negative balance sheets and massive loss makers. We could have a quick look at the results. When Ferrari, since that time period, we saw a 59% annualized rate of growth in free cash flow. This is trailing 12 months between then and kind of what's now visible. Revenues continued not to grow much. If they hadn't before, it was more of margin gain, but cash from financing is increasing hugely negative, up 223%. So it's pumping money back to investors. It's buying you more of the company. You're getting a higher percentage ownership, and you're getting dividends, and the company's getting better. And in that time period, up 16.7%, annualized at 36.3. People often ask for single stock stories. Single stock stories we consider statistically insignificant because our top rated stock only has about a 60% probability on average of outperforming the average stock. Our bottom may be about a 30% probability of outperforming the average, or 70% of underperforming. So single stocks we still consider very noisy things, but for the purposes of this, they might give some insight into what's going on. So Ferrari, if we look at PE ratio, which is price to by earnings, if we invert it, then we get yield. We can see that Ferrari has about a 3.5% yield versus 5.9% for average stocks in the world at May 20th. But this goes back, so it's not something that when I first started in systematic investing that I would have necessarily been drawn to, or even when I first started thinking about investing. So I said, well, I'm not only getting like 3.5% profit, but it's like Buffett says here, I'd rather buy a good company at a fair price than a fair company at a good price. Because if a company can increase its profits, let's say 20% per annum, and only makes 1% profit, then it's going to keep that same valuation level because the growth rate's constant. You're going to make 21% per annum in the mathematical limit, right? So that's something that it's clear that over 1 million years of data, Alba's hacked, and Alba seemed to hack it pretty quickly. Natural Shrimp, unsurprisingly, did a refinancing. No shocks there if you looked at their data. So we can see here net income continuing to be very poor. Cash from financing is going up to support the cash from financing is going up to support the cash from the negative free cash flow. The company's still yet to make any money. The company's bust very soon, and is going to have to keep refinancing. We can see that refinancing is moving over to equity away from debt. Probably they've run out of lines that they can draw on debt, so they're now starting to squash the investors, aka issue more pizzas. You're getting to own less of a company that's not doing anything with money except borrowing it. And again, what's happened with this stock? Dreadful. So it's down 70%, bounced back up, back down again. These are 1 year forecasts, and annualizing at minus 69. But it's a horrendous ride for an investor. You don't want that kind of volatility. It's a speculative stock. It doesn't really have an underlying business. If we look again, looking at how Alba's thinking about these two stocks, you start to get an insight into what Alba's thinking. And we can see that on Natural Shrimp, the shrimp company in blue, is putting more weight into thinking about credit risk, presumably because the credit risk models are actually very relevant for that company. It's at any one time, maybe 1 or 2 years at most away from bankruptcy. Accounting forensics, there's very little accounts to when you don't have any revenue. There's not much going on in accounts other than costs. So accounting forensics is put more weight into Ferrari and digging into that. Shareholder treatment more to Natural Shrimp, because it's seeing that if we look at the treatment of shareholders, we can see they're basically getting crucified. There's nothing good happening there whatsoever. And if we look at clarity of business model, again, more thought on Natural Shrimp. So, a clarity of business model is not something that you'll see in any quantitative work on investment, but it is the thing that, like Warren Buffett will say, the clarity of a business model is very important to a business. You wouldn't invest in a business that's not clear on its business model. I think Alba, we've engineered features that enable her to kind of see that, is therefore putting a lot of thought or weight into the importance on the lack of clarity of Natural Shrimp's business model, having no revenue and the like. And again, company physics, that's internal compounding. So there's a lot of analysis on Ferrari's internal compounding relative to Natural Shrimp. These are just relative weights of how much analysis it's putting, comparing the two stocks. And to us, everything here kind of like follows from understanding what the business is. But are we done for time? I can stop.
So,
Yeah.
Any questions? Any comments?
I'll leave this one up for you. But yeah.
So when you mentioned that you had, say, 5 years of researching fundamentals and understanding what exactly you wanted to do in investing, does that result in, say, a hierarchical structure of data that you wanted to acquire and then you would...
So it's probably, to date, it's actually probably about 21 years since 98, but or since I was 5.
The idea was that you would define quite a clear structure before even tackling the algorithms themselves.
It's been a very evolving process. So I didn't originally even though I studied machine learning, I wasn't making a great deal of use of machine. I mean, I was using machine learning, but I hadn't taken it to full scale kind of what you think of more like deep learning. And we use a mix of everything. So we're using neural nets. We use I'm not going to go into a great deal of detail, but we do use like the full array pretty much, or we allow Alba to use the full array and kind of figure out as she's going. But obviously she can only learn from the past of the past of the past when she...
So that the structure can evolve as Alba trains itself?
Yeah, it's changing all the time. So in each month through time, it's a different Alba essentially, because it's learning. There's more data arriving all the time, so she's getting better with time as we see. So when we look at all the analysis, if we look at the correlations over time, we see, for example, in 98 to 2000, they went negative. That was a dot-com boom. We see in the credit crunch, they went negative. Everything went down, so there wasn't really much differentiation. It went only marginally negative, but it was negative. So it's not working all of the time, but we think this is a bit like a tournament. A professional poker player should learn to play the correct statistical game, which is the one that would maximise the amount of probability of tournament winnings, not the thing that wins in every hand, if you see what I mean.
Sorry.
Yeah.
Anyway, thank you very much.
Thanks.